Hi, everyone. My name is Julie Hope, and I work at Montana Housing in Helena, and I'm going to be your room host for this session. So we're excited that you've joined us today. We ask that you mute your lines and use the chat function for questions. We'll try and address all questions before the end of the session. Let's see. This session is both sponsored by and presented by Federal Home Loan Bank of Des Moines. Just a few housekeeping items. All sessions are being recorded, and we ask that you mute your lines and turn off your video while the presenters are presenting. Please click on the chat icon, select all panelists and attendees, and enter your name, organization, and location. And you may turn your video back on during our Q&A times. So I am going to, one more thing. You each were given a whiteboard paddle and a marker in the mail. If you find something inspiring or exciting or new, write a quick adjective on the whiteboard, hold it up, and let us know during the Q&A time at the end of the session. So I am going to turn this over to Ryan.
All right, thank you, Julie. Real quick sound check. Can you hear me okay?
Yes.
All right, perfect. So welcome to the group. I've been told you don't want to be the group that goes before lunch. And also you don't want to be the group that goes after lunch. I'm not sure which one's better, but for those of you after lunch, we'll see how this goes. And hopefully you guys are able to get some lunch in between the sessions. But welcome to the Federal Home Loan Bank of Des Moines presentation on affordable housing programs. My name is Ryan Sullivan. I'm the home ownership manager within our community investment department. I'm joined today by two of my peers, Melody Dawe, who's our down payment assistance program manager, as well as Renee Mars, who's our rental housing manager. So I'd also like to once again thank Julie for her help today in hosting this and getting us all set up. Before I go through the agenda, I just want to thank you. So thank you for taking the time to understand a little bit more about the opportunities we have at the Federal Home Loan Bank in Des Moines, but also the work that you guys do on a daily basis. Affordable housing is critical right now, as we all know this, but it's been critical 5 years ago, 10 years ago, 15 years ago. But even today, it's more and more critical as we think about it. You guys are the boots on the ground for some of the projects that we help out with, and we sincerely appreciate that. So thank you. Going through the last year and a half with a pandemic, and then also having to go through record prices, trying to get materials, and then trying to get labor to do some of these materials is just got to be a huge undertaking for you as organizations that are really building and influencing affordable housing within your community. So thank you for what you guys do on a daily basis. I truly appreciate it. So today we're going to go through three main areas on it, and there is a bit of a lag, just so you guys know, as we switch screens here. So we'll go through the agenda. So the first thing we're going to do is just touch base on what really the Federal Home Loan Bank in Des Moines is. A lot of people don't know who we are and what we do. So that's the first thing we'll go through. The next thing we're going to talk about is our affordable housing program, or our general funds. In there, we're going to have three things we're going to talk about. So we're going to have an overview and the project types that you can do. We're going to talk about eligibility, feasibility, and scoring of the projects. We'll probably spend the most time in that area. Then we're going to just touch base on a few case studies of a few projects that have happened over the past years, just to give you an idea of what some of them look like if you're not familiar with it. We'll have a quick Q&A session after that. Then we'll touch base on some down payment assistance programs, and then have one additional Q&A process after that. So we're going to have a bunch of information today. And the thing I want you guys to think about as you're sitting there is like, don't worry about consuming all that information. I really just want you to think about what opportunities do you currently have going on, what opportunities that may be going on, or you might have peers within peers out there that might have a project that might suit our project as well. So just as you go through it, just be mindful that you don't have to consume all this information, but your real goal is just what might fit this, and then reach out to us afterwards, and we'd be happy to visit with you to get more details around it. So we'll kick her off there. So who is the Federal Home Loan Bank of Des Moines? So we're a member-owned cooperative that provides funding solutions to nearly 1,400 members to support their mortgage lending, economic development, and affordable housing within their communities. And you might ask, what is a member? So members are generally banks, credit unions, and even maybe insurance companies. So I would venture to guess most of the banks and credit unions within your area are probably a member within our organization. There are 11 federal home loan banks across the United States, and you'll see the maps, and it's broke out by the regions for each one of those banks. In our district, we have 13 states, as well as Guam, North Mariana Islands, as well as American Samoa. So basically everything in that dark green is our Des Moines footprint that we're in. So the Northwest part of the United States, as well as Alaska and Hawaii. And how we come up with these grant funds is 10% of our net income on an annual basis is allocated towards affordable housing each year. Moving on to what the housing program or general fund is. So the simple question here is, what is affordable housing? And once again, I'm going to apologize. I'm kind of getting a bit ahead. I know there's a lag once again. But what is affordable housing? So affordable housing, it's a competitive subsidy award program that we have. It has been in place since 1990. And we have awarded, Federal Home Loan Bank of Des Moines has awarded over $602 million in lifetime awards. With our most recent project of 2020 was over $41 million that year. Our program guidelines, it's really our how we operate and our sponsors and members. They're housed in our implementation plan. So it's really your guide to how you operate. So the next question is, what is an AHP funding round? So as we mentioned, it's a competitive program. It's done on an annual basis. So we accept applications on your projects on an annual basis, and we'll touch more about the timing of this in a few slides. So it is competitive, it's annual, and it is once a year. And our 2021 project limits are $750,000 per project with a maximum of $40,000 per unit. So the types of projects that would fit under our AHP program. So there's a lot of things that can fit in there. There's purchase, there's construction, there's rehabilitation, there's acquisition rehab for it. So there's a lot of different types of projects that fit in there. Also, they have the full spectrum of rental or home ownership with it. So the gamut is pretty wide that we have. We target the households under 80% area median income, as well as with rental projects, 20% of the households must be below 50% area median income. And the AHP projects are awarded, and they're based on the eligibility, the scoring, and feasibility. So every year, as I mentioned before, we have, I'm going to keep it very simple, but we have a pot of money. We evaluate the projects, and it goes down until that money is gone. So you'll ask if you have not been involved, is who is involved in it as an AHP project? So number one is the sponsor. Number two is the member. And number three is the bank, the Des Moines Bank. There could be also many others in there. There's a potential of additional funders. You'll see in the projects that there's stack funding going on. So we might just be a small piece of the funds that are going into the project that you're working on. So the types of projects, we talked a little bit about rental and home ownership, but it's a very wide net, as I said. So new construction, we have acquisition rehab, we have rehabilitation and rental preservation in those units. So there's two main kind for home ownership. There's consumer driven, also the homeowner kind of drives it, and then also sponsor driven. So the sponsor has to be is obviously involved in both of them, but it's owner occupied rehabilitation or down payment assistance or closing cost assistance. But then sponsor driven, where they're new construction for sale or acquisition rehabilitation for resale. So sometimes we spend time talking about with people, what are sponsors, what are members? And the next couple slides, we're going to talk about what a sponsor is. And then we'll dive into what a member is as well. So the sponsor is typically a nonprofit, governments, including Native American tribes or housing authorities that are conducting affordable housing projects. So most, if not all of you on this call would fall into this bucket that we have here. So to be eligible, you have to be integrally involved in the planning, development, or the management of the project. And then in rental projects, you have to have a controlling interest in the project. For-profits can absolutely apply for the program, but they are not awarded points from a competitive scoring perspective. So that doesn't mean you can't apply and get it, but they're from a scoring and how we score these out, you just don't get points for-profit. So from a member aspect, all applications require that support of a member, a financial institution. And so you might be working on a project or have a project in mind, but you just don't have a member identified yet, or you just don't know who to go to. On our website, we have that list of 1,400 plus members that you can work with. You can drill down into your area and find a member that is in a location near you or where your project's going, and reach out to them and have a conversation with the member if they would want to partner with you on that project. So it's not a problem at all if you don't have a member identified right away, but you'll need that as you go through that application process. There are a lot of benefits for being a member as well. So they service their community and support of their housing mission. It fosters community relationships. It expands their customer base. It can help with their community reinvestment compliance. It's the housing programs that benefit the economic development, and you're also leveraging local dollars. Melody, I'm gonna see if this catches up a couple slides here. One more here, Melody. Thank you. Allow me to get a drink of water there. Oh, you can go back. So the application round schedule. As we said, this is an annual process. We are right in the middle of our application round schedule. It's not too late if you're interested in this, but you will have to get kind of a hop on it, if you will. It starts generally May 1st and ends kind of the end of May, 1st of June timeframe. And this year it ends on June 1st at 4:30. And then we do all the application processes in what we call AHP Online, which is our system. And then once all those applications after June 1st, awards are announced sometime in that December timeframe. So a lot of work goes in between that application period to the announcement. And we're going to talk about that over the next 10 or so slides. So if you have any questions about this, the one thing I want to point out is projects that you're already in the midst of starting, may not qualify, but you're interested in. What I would really encourage you to do is reach out to us and talk through it with us to make sure you just don't make that assumption saying, hey, it won't qualify, so therefore I'm not going to submit an application. Or in future projects, you might want some funding. There's a point where a project is far past where you won't get the funds for it. So please reach out to us. We'd love to have a conversation and see where that project's at. So after that application is submitted, there's really three key areas we look at. Number one is the eligibility of a project, the feasibility of a project. Is it really going to happen? And then the scoring, where does it fall at for our program? So what is eligibility? We talked about the first few of these already, but is it a rental or home ownership? Is it for purchase, construction, rehabilitation of affordable housing? Is it meeting the criteria of the rental and home ownership of being under 80% AMI, or at least 20% of the units being 50% AMI? But the big thing I want to call out on this slide, or a different thing I want to call out, is we're the last funder to your project. So we need to see a demonstrated need for subsidy in your project. There's a timeline of it. So for rental projects, it's 36 months, and for home ownership, it's 24 months. And that clock starts when the awards are announced. So I mentioned December, roughly whenever those awards are announced, that's when that clock starts, would be December. So you'd have 3 years on a rental project to complete it, or 2 years from a home ownership project. And we're going to want to see that, hey, we're doing a home ownership project and we're saying it's going to be done within 24 months, not 48 months on it, and so on. The last piece of it is there is retention of affordability or deed restrictions on these. So 15 years for rental projects, and then 5 years for home ownership projects. And the one thing I want to point out for the home ownership projects is the deed restriction is excluded for rehabilitation projects. So there's no deed restrictions included in those. So just acknowledgement the work is done and we move on. So really only it's the new construction or acquisition rehab on that. So with that said, I'd like to turn it over to my peer, Renee Mars, and she's going to talk a little bit about scoring and feasibility.
Thanks, Ryan. First, I want to apologize. I am having technical difficulties with my camera. I'm not quite sure what's happening. I'm on the camera quite often, so something with my compatibility and the camera on Zoom, it's not liking it, which is unfortunate because it's one of the few mornings that I think I've gotten up and gotten ready in quite some time. So I want to apologize for that. As I'm going to spend a little bit of time here talking about scoring and a little bit on feasibility. As Ryan had mentioned, this is a competitive grant application. The scoring is made up of 7 different scoring criteria. Those scoring criteria equal a maximum of 100 points. As you can see on the slide, those are noted as either variable or fixed. And the difference with that is a fixed scoring category is either you get the full 10 points or the full points, or you get no points at all. If it's variable, you can get up to the maximum points, but you could have less than up to 0 points as well. Even though there's 100 points maximum available, don't worry, you don't have to get 100 points or anywhere near 100 points in order to be competitive or be awarded. We'll go over what the last 3 years historic point range has been for awarded projects in a few slides. Also want to note that our scoring changes from year to year. And in January of every year, our scoring is published on our website in the 2021 for this year AHP implementation plan. If you're considering submitting an application either this year or in future years, I want to suggest having that implementation plan readily available for you. I've been here for quite some time, and every year I see applications come in who miss out on opportunities for points because they don't fully understand what those points are. And our implementation plan, or we call it the IP for short, it does a very nice job of kind of outlining what qualifies for those points and what doesn't. So I just want to point that out. Don't miss out on points that your project could potentially get. Next slide. And it looks like we're on a bit of a lag, so bear with us here.
You can't see it, Renee?
No. Did it move?
It did.
Yeah, it advanced on my.
Yeah.
My screen completely locked up. I can't move anything. It's moving. Hold on.
Do you need Ryan to take this piece until your screen frees up again?
Well, I'll, well, I apologize, team.
Do you want me to go ahead here, Renee? I don't know if you have a hard copy.
Yeah, if I can't even get my PowerPoint to come up, so
That's okay. That's okay. Absolutely. So
we just have to pitch it on this one a little bit. I'll jump in where necessary, though.
no problem. No problem. All right. So the first criteria is, as Renee said, we have 7 criteria, and once again, as I kind of started off there, on a few of these slides, there's quite a few words. Don't get intimidated by the words. This PowerPoint's available to everybody afterwards, and you can dive into it a little bit more if you choose to. But the first one is around donated and discounted properties, and you'll see at the top of these as we go through, they're either variable or fixed. So it'll be on a sliding scale. Variable, obviously. Fixed is just if you have A, you're going to get B. With it. So for the first one is 5 points. It's variable. The first one on there is that, you get 1 point for any land or units conveyed by a federal government, or up to 5 points for land or units donated to the project, a minimum of 20%, or up to 5 points, for land or units purchased at a discount at 20%. They have to be arm's length transactions are eligible for points. And long-term nominal cost leases may qualify with it. So donation or conveyance must have occurred. I think this is a big one within the 3 years of the date of the AHP application, or 7 years at the discretion of the bank. So this is one where if you have questions about it, and Renee kind of said, hey, I didn't give myself points because it's in there, this is when you'd want to reach out on to say, hey, we've had this land for maybe 4 years and this is how we acquired it. Reach out to us and we'll absolutely have a conversation with you.
It's got leg, Ryan. If you have it printed out, you might want to just stop now.
So the second one on here is nonprofit or government sponsorship. So as I alluded to in an earlier slide, this is 10 points and it's fixed. So it's either not-for-profit organization, state or political subdivision of a state housing agency, Native American tribes, Alaskan Native villages, government entity for Native Hawaiian homelands. So if you qualify for any of those areas, this is 10 points for your application process. Once again, the sponsor must be integrally involved in the project. On rental projects, the sponsor must have at least a control at greater than 50% controlling interest in both the governance and decision-making, as well as financial interest in any returns provided by the project. From a homeownership project standpoint, sponsors must play at least 2 of 3 roles within it. So number 1, managing acquisition or construction or rehab of the project, or qualifying home buyers, or directly providing empowerment services. The third criteria is income targeting, and this is 20 points. And this is a variable scoring piece. So rental has a minimum, minimum eligibility is 20% of units must be under 50%. Home ownership has an eligibility that has to be under 80% AMI. And we won't go through this in depth, but for home ownership, let me give you an example. The more units you do under 60% AMI, the more points you would receive on it compared to all of your units being only at 80%. So the further you go down, the more opportunity you have for points to score within the income targeting piece. So households must have incomes meeting the income targeting at initial occupancy of the unit, and they'll be verified at the project completion. And then occupied projects, rental housing units that are occupied at the time of application must meet the targeting commitments made in the application or have a solid plan for meeting target commitments at a project completion. So rent rolls will be important. Yep.
Can I make, this is Renee again. I'm still locked up here, but I just want to make a note on targeting, at least for rental projects. So if a project is going to maximize points, you get your maximum points at 60% of your units, less than 50% AMI. It may be a good idea to think about your targeting from a future perspective. As Ryan had mentioned, this is a 15-year retention period. 15 years is a long time. So you may want to consider, if you maximize your points, if you had, let's say this is a 10-unit project and you are going to commit 6 units below 50% AMI, it may be a good idea to move those 4 remaining units up to 80% area median income to allow for flexibility in future years. Some projects choose not to do that because they have other funding sources and they want to keep the targeting consistent, and that makes sense. But if you don't have those restraints, you might want to consider some flexibility there.
Thank you, Renee. And criteria 4, Melody, if you, system will allow you to, there we go. That one worked that time. So the criteria 4 is promotion of economic empowerment. And so I mentioned this, just as a prior example from a homeownership being involved in 2 of 3 items. One of those was promotion of economic empowerment. And so projects must commit to providing at least one economic program or service to all residents to receive points. And so what they might look like, if you're trying to frame up what does economic empowerment look like is, it might be education such as financial literacy or GED, childcare, adult daycare services, after-school care, tutoring, health services, workforce preparation, integration, or just to name a few. I guess the last one that people use a lot is home buyer or home ownership tenant counseling with it. So there is a very broad list that either the sponsor provides or they have a partnership with somebody that provides this. So promotion of economic empowerment, you need to provide at least one of those. Services must be offered and available to all residents, absent program eligibility requirements criteria. And the proposed program or service must be appropriate for the target population. So does it make sense if we're offering, financial literacy to, or maybe a GED, to somebody that we're targeting the elderly? That might not be the best fit, but there could be another one that might be a better fit for it. So we're going to want to make sure that what the programs that you're utilizing are really targeting the appropriate target population. Project programs or services that promote residents' quality of life or personal well-being, but not their economic betterment, do not qualify for points. And the basic referral services are not eligible with it. So all of these are listed in our IP that we do. As I've said before, if you have questions or what might fit in to it and you don't see it on that list, reach out to us. We're happy to take a look at it and see what might qualify or if your program does qualify that you offer for it. So our underserved communities, criteria 5, is really 3 buckets here that we have. And up to 25 points, it is variable again. Housing for homeless is the first one. Housing for special needs is the second one. And then housing for other targeted populations. So veterans and agricultural. So veterans, as we mentioned before, our IP, our implementation plan is ever changing. This is an area where it has changed this year. where we have changed or modified the definition of agricultural, but we also added veterans to the program as well, to where points can be given if we're serving that group. So 25 points for homeless, special needs, and veterans in agriculture. Renee, anything you'd like to add before I move on from that slide?
Yeah, I think I'll just add that it's, you know, for the homeless, well, actually for all three of those, it's a laddered score approach. So for homeless, for instance, you can, you know, it ranges from 5 to 10 points dependent upon the percentage that you're willing to reserve for those households, whether it's special needs or homeless. Also like to mention that the Federal Home Loan Bank of Des Moines has its own definition for homeless, and that definition can be found on our implementation plan. It's very closely aligned with HUD's definition of homeless, except we allow for doubled up, and so that's a huge bonus for a lot of projects that HUD doesn't allow.
Thank you. That's a good point. All right. You beat me to the punch here, Melody. So criteria 6, it's community stability. It's 12 points. It's variable as well. The first one here is adaptive reuse. So it could be a building that you're turning into condos, or then rehabilitation or demolition of vacant property. So you might have, 4, houses that you're going to demolish and put new houses on, or 12 points for rehabilitation of owner-occupied housing. So rehab work that's going to help with the health and safety of homeowners with it. So that's under the home ownership. And then rental, and Renee could probably dive in just a little bit more with this, but they have 10 points for the preservation of federally assisted housing, 5 points for adaptive reuse, then 5 points for rehab and demolition of vacant building, and then 5 points as well for acquisition and rehab of natural occurring affordable housing.
Yeah, I can speak here quickly on the rental points here. So for the preservation of federally assisted housing, that would include HUD Section 8 project-based rental assistance projects, PHA and Rehab Authority-owned units, HUD 202, HUD 811 projects, USDA 514, 515, 516, or existing LIHTC projects. Those all qualify for preservation. 10 points is a huge point boost for these projects. So if you qualify, be sure that you're selecting that you do. In terms of adaptive reuse, this is when you take an existing building and you change its use. So an example of that would include taking a school, for instance, and changing the use from a school to housing. The caveat with adaptive reuse is that it has to be 100% of your units. So if I were going to have a 10-unit project and only 5 of those units were going to be in the school, former school, now housing, and the other 5 are going to be elsewhere, that would not qualify for points for adaptive reuse. For the vacant and abandoned of rehab or demolition of vacant and abandoned building, there has to be a public nuisance. It has to be chronically vacant or uninhabitable due to its condition. It has to be a blight in the area. So just having a vacant building, just because people have moved out, doesn't necessarily qualify for this. There has to be some significant, some underlying issues with that building, and we would need documentation to support that. An example of the documentation may be a letter from the city saying that the building is a blight on the area. And just to describe briefly with the 5 points for acquisition and rehab of naturally occurring affordable housing, that's taking a non-income restricted unit and turning it into an income restricted affordable housing project. We would require a titled opinion to demonstrate that the project has no income restrictions on it in order to qualify for points in that category. And that's all I have for the rental
All right.
pieces at least.
Yep. Thank you, Renee. All right. Criteria 7, and that's our last criteria that we have. And we have it broke out between homeownership and rental, but they're really similar outside of one item in each. So the first one is 5 points. I should start off, it's 23 points. It's variable as well. But the first one is 5 points, and 100% of the units located within the Federal Home Loan Bank Des Moines district. So you remember the footprint that we're in, the 13 states across the Northwest. As long as 100% of the units that you're doing are within that footprint, you'll be 5 points. 13 points for a native housing project. That is the same for both homeownership rental. I'm going to skip down to the bottom one. It's AHP subsidy per unit, and you'll see 0 to 5 points there. That's on a sliding scale, and those points are awarded depending on all the projects that are stacked up, right? So the project with the lowest subsidy per unit will get the most points compared to the project with the highest subsidy of unit gets 0 points. So it depends on where you fall within your project, and that changes obviously from year to year. The points change it from year to year. Then the different pieces of it. So there's 12 points under home ownership for sponsor-driven new construction of single-family owner-occupied units. And then from a rental perspective, any new construction that has 24 units or less will receive 10 points on it. So once again, the max for this is 23 points. Any one of those can get you up to that 23 points, or combination of those can get you up to the 23 points. So they're very similar outside of those two I differentiated or called out within there.
Brian, is the next screen? I'm still hung up here. I apologize. But I think the next screen is feasibility, and I could probably speak to that. Mm-hmm.
It's just a pass scoring. I'll take this pass scoring, and then you can take feasibility if you want to.
I don't remember those, though.
Yeah, I wouldn't expect you to. Hey, hopefully this does come up. Yeah, no, that's okay. So from a pass scoring perspective, and as one of the slides, about 8 slides ago, you saw that you can receive up to 100 points. And we would expect no project to come in at 100 points. And if you did, we would probably really question how you're coming up with that 100 points. And the reason I say that is in our funding round, our last funding round of 2020, we had low 40 million in funds that we completed. There were 63 projects that we awarded funds to. And the scoring range was 76.27 down to 62.18. All right, so that kind of tells you that range that you're at. In 2019, we had $54 million. And the number of projects we awarded were 85. We had a little bit more money, a few more projects, but the scoring range there was 76.18. So almost identical to the high for 2020. But yet it went down to 59.22. And then the last one I want to give you, so the 3 years, 2018, we had 52 million, and we awarded 109 projects in 2018. Our high was 77.33, and our low was 59.46. So as you think about these and you're thinking about your projects, it's really easy to kind of do some back of the napkin math to figure out where you're at. This is generally where our projects have scored over the last 3 years. So you can tell ahead of time if you're in that ballpark or not. And if you're, kind of on the low end side of that or high, or something really doesn't seem right, that's where you need to give us a call and let us walk through, let our analysts, visit with you about your project to make sure that we're getting the right points for you, right? We want to make sure you're getting the points that you deserve, but not overcommitting is either. So you're not successful. We want your project to be successful. All right. Project feasibility. Renee, do you want to take that one?
Yeah. Let's see how my memory goes. I can't see it, but so project feasibility, I have to giggle when we get to this slide because we at the Federal Home Loan Bank probably spend 6+ months just doing feasibility review. But yet there's only really one slide to describe it. But rest assured, there's plenty of information in the implementation plan. There's a huge section that outlines what project feasibility entails. But basically, we have a set feasibility guidelines that talk about project costs, revenue expenses, the affordability of the housing, et cetera. Whether you're home ownership or rental, you will be asked to upload a feasibility workbook. And those workbooks have several tabs that include sources and uses, cost breakdown. For rental projects, we'll want to see a pro forma, et cetera. And when you upload that into AHP Online for an application, if you are outside of what we have for a feasibility guideline, the online application will prompt you to discuss why. So we'll want a justification as to why a project is not meeting a feasibility guideline. An example of this would be, you know, for a rental project, we have a maximum operating expense per unit guideline of $5,000 per unit. Let's say you have a project that has a $6,000 per unit guideline. You'll be asked to describe why this project is unique and why the guideline is being exceeded. Now, a justification that could be acceptable would be that the owner pays for the tenant utilities. And that's what's causing, if it's a big project, that could certainly increase your cost considerably. And that would be an example of where we would grant an exception for exceeding a guideline. So don't let, if you do exceed a guideline, don't let that scare you. We just need the justification as to why. A lot of projects that we award every year have exceptions granted. Also just want to note that you have a complete application. There are a few applications we get on an annual basis that have incomplete or inconsistent information, and that could disqualify an application from being considered for funding. With that, back to Ryan to discuss some previously awarded projects and some samples of what that looks like.
Yep, and I'm going to touch on these just real quick. I know we're running out of time here. We want to save some time to go through down payment and also some Q&A. So this first one we have here is from Edina, Minnesota. And it's really a pretty neat story where it's a youth shelter. It's 39 units. It was a $11.5 million project that they did. And the unique one around this is the community support with some vacant land that they really pushed the city council on. So it was really neat to see the community support come into this thing and really drive getting this thing built with it. So as you can see, there's a stack of money there. Out of the $11.5 million, only about $273,000 was AHP funds, but there's all different sources of funds that were coming into this one. The next one is a rental rehabilitation in Casper, Wyoming. It used to be a state orphanage, and they moved this over to a 50 unit for homeless women and families and people with disabilities, homeless teens and domestic violence, as well as families that had an emergency. So they would need some quick housing with. And so this $1.6 million rehab, you can see the Federal Home Loan Bank was able to assist in their gap of about $265,000. Then from a home ownership perspective, in Utah, we had some self-help, owner-occupied new construction. It was about 43 homes, $10.5 million. It was kind of parlayed with USDA, low interest loans. So it was really a great spot for the self-help, the USDA, and then our monies to come in and kind of help out to get it across the line to the tune of $387,000 with it. So it was able to put 43 families in houses. And the last one before we have Q&A is our owner-occupied ACT rehab. So this was 5 homes. It's a Habitat for Humanity in Des Moines, Iowa. They took 5 vacant lots or five vacant homes, excuse me, and remodeled them and provided 5 homes for families. And so, and this is per home, the capital stack here is 9,000 in AHP funds were used, and the average house cost was a little over $120,000. So wanted just to give you some samples of types of projects that we're involved in. Yeah, we do a lot of rehab and stuff like that as well, but there's some projects that we see often that come through our like type projects. So with that said, Julie, do we have time, or can we do a little bit of Q&A before we spend 5 minutes on our down payment program?
Yes, you've got some time yet.
All right.
So Ryan, there's a question in the chat.
Yeah,
Billy asked, are the project feasibility workbooks available on the website as a tool for potential applicants?
Absolutely. Absolutely. They're out there, and you'll have them by year. So there'll be a 2021 out there, Billy, that you can take a look at.
Also, really, all of the, because we're in the middle of our round right now, all of the exhibits are out there. So even if you're not wanting to maybe apply this year, but you want to get an idea of what those exhibits look like that you'll be asked to upload in an application, those are all out there as well as a self-scoring spreadsheet. So if you want to try and self-score your project to see if you think that your project could be competitive, there is a tool out there that can assist you with that as well.
All right, any other questions? All right, Melody, you want to take your couple slides?
Sure, we'll see if it will advance. There. The controls keep disappearing, so, and then they reappear and they lag. Okay, so I'm Melody Dawe. I'm the down payment products manager for the Federal Home Loan Bank of Des Moines. And our down payment assistance programs consist of NAHI and HomeStart. NAHI is Native American Homeownership Initiative. These assist first-time homebuyer households with a home purchase. The funds can be used for down payment, closing costs. You can use it to make property repairs or rehab associated with the purchase, or homebuyer education and counseling. It cannot be used solely for homebuyer education and counseling. You must choose one of the others if you're going to choose that option. We assist households below 80% median income based on household size using the guidelines set by HUD each year, or NAHASDA limits for NAHI. This is a members benefit program. So as Ryan explained earlier, our members actually submit the reservations into our system. We work, AHP works on the rental and homeownership projects, works in the future for this project that's coming about. And we work in real time with the open market and with our members who actually submit reservations for their buyers who fit within these criteria. The funds are available to members on a first come, first served basis. They use these funds on maybe loans that they're originating themselves, they have a buyer who's buying a home. They're passing the funds through maybe to another lender because maybe this lender doesn't actually lend residential mortgages. Maybe they work with another partner, and then they might also work with a nonprofit like Habitat or a NeighborWorks organization. We see all of those scenarios come through. These funds can be layered with other down payment programs. I'm stuck once again, so I brought it up on my phone just so I could do this. The next slide actually speaks to our funding. So as of 12/31/2020, last year, we had $11.5 million that we funded in 2019 in that single year, and $7.14 million in 2020. Total lifetime of the program, we've actually funded $142.1 million in lifetime awards for first-time homebuyers. What that $11.5 million translates to in 2019 was 1,955 homebuyers, and in 2020, 7.14 translates to 992 homebuyers. Our lifetime awards are 30,887 homebuyers who are assisted with our program. If this ever catches up, sorry, but I'll just march ahead. In 2021, we have $7 million available on a first come, first served basis. We fund quarterly so that members can count on where that funding is coming from. They can make sure that they're able to actually plan ahead for when they have a reservation coming in. HomeStart has a $7,500 individual household grant maximum and a $90,000 member cap. So what that means is that a member can use up to $7,500 at a time to assist the household, and for the full year, they have $90,000 available to them. Doesn't mean that they'll be guaranteed $90,000 because we are first come, first serve, but it does mean they have access up to $90,000 for HomeStart. In NAHI, the Native American Homeownership Program Initiative, we issue funds to eligible Native American, Native Alaskan, Native Hawaiian homebuyers in our 13-state district. HomeStart can be used anywhere in our district as well as in the U.S. as long as the member has a charter there. But NAHI we keep within our district to make sure that our Native buyers benefit and we aren't spending the funds in another district to be able to do that. We have funded this year $450,000 for NAHI. Again, it's available on a first come, first served basis. That's up to $15,000 for an individual grant maximum. Again, you can use less than 15, but we often see 15 is consistently used because Native homeownership is quite expensive. And again, a member has a $90,000 cap that they can use with that. I want to point out that NAHI, you do not have to be a first-time home buyer. We define a first-time home buyer as has not owned a home or been entitled to a home in the last 3 years. There's a few exceptions. But NAHI, you do not have to be a first-time home buyer to be able to participate in the program. And we fund that quarterly as well. And then we have our contact info, which is not showing up at all. Sorry. I can't get to the screen. I apologize.
So Melody, let me ask you this. If I were a sponsor, why are you telling me about this member stuff? Tell me your answer to that.
If you were a sponsor, well,
yeah,
tell me if you're an applicant.
No, if I'm a sponsor, yeah.
Yeah, you touched on that earlier. We have members. We have a large number of members. We actually have a participation list on our HomeStart and NAHI pages. So if you want to work with a local banker, a local lender, or an insurance company, credit union, as Ryan pointed out, there's potential for partnership within these. It is important to note that if you have AHP money within a project, that same unit cannot be submitted to us at the time of sale to bring in HomeStart money. We can't double dip on that, but if maybe you have units that you weren't able to do that, you can bring some of the HomeStart money into the project.
Okay, thank you. What questions do we have for Melody, or even taking it back to the competitive round?
You all can unmute yourself if you're able to ask a question, or type your question in chat as well, if that makes it easier.
Melody, this is Nancy from RCAC, and I work with I work with the USDA Rural Development Self-Help Grantees as their technical assistant providers. We're suffering right now from a mass case of expenses going through the roof, and a lot of our homes are existing mortgages that the families have taken out with USDA are not going to be sufficient to cover the house, the funding.
Mm-hmm.
Is there any way to do, or possibility to do, down payment assistance even though the home is under construction?
And so that's a really great question, because we do actually do a lot of self-help, and we do 523 and 502 takeout. We see that a lot. This is something I was discussing with one of our members last year, because the project was running really long and getting outside of our guidelines. So it is something I'm investigating to do, maybe at conversion when the project's converting to permanent financing, if we're able to bring it in at that point. It is something we have to work with on the side because of the specific documentation required at that point. We need to make sure we're able to test for compliance the way that would fit in. But I'm not going to say no, but we're working on it.
Okay, so that's one of the questions that came up with another funding in Colorado, because there was some funding available, but they don't want to come in till certificate of occupancy is issued. So we've got a gap we're trying to fill. So basically we'd be in the same position, right? Because you want to have that certificate of occupancy issued so you can make sure the home is complete. If I understand.
Yeah, so we would have to pick a stage. Yeah, we have to pick a stage where they're actually, you know, when we work within our regular program, it's actually, we pre-approve the reservation and then our members submit for reimbursement to get their disbursements back. They fund up front. So, and we don't know that something's actually gone all the way to closing until that point. So the thresholds, we have to make this process fit within those steps somehow.
Okay. And just, I've been trying to convince a lot of my grantees to consider, because I used, when I was a grantee many years ago, and I used Federal Home with Bank. I think, every build I did, I used it. So I think it's great additional down payment assistance. But it's been a long time. So other than going on your website, or is that the first recommendation you'd say for me to help them would be to go on your website and check things out and go from there? Or?
I wouldn't say that. I actually just did a training for a USDA housing specialist who hadn't worked with our program for a couple of years last week. So I would say a good step here, because you're going to be passing on information, might be for us to set up some time to talk. And then we can even set up a time with a training with those individuals who might want to access these funds. That
would be awesome, because I bet you we were in 14 states, or 13 states rather. So not all of which are, of course, are going to be under your jurisdiction, but for mine are, and there are some others too. So that would be excellent. Yeah, if we can get in touch, that would be wonderful. And I would just. Sorry,
I'm just going to say, Jessica Grant, who's one of our analysts, just shared in the chat the link to the participating members list on our down payment site. So that's a good place to start. If you're looking for someone to do the first mortgage, I mean, USDA is going to be doing yours, but for the others on the call, that's a really great place to look to see if you maybe have a potential partner out there that you want to work with. Or that you can talk them into it.
Okay, great. Yeah, it is funny because some of our grantees are using other funding besides Rural Development 502 just under certain circumstances, and then doing a takeout with 502. So that's another interesting aspect of what's going on.
Yeah, we do a lot of takeout. We do a lot of takeout, 523, self-help, guarantee. We do the gamut. We see a lot of different financing. So, we have some criteria, but USDA doesn't have any issues with meeting those criteria as a lender.
Right. Excellent. Okay. Thank you so much.
All right.
Sure.
I'm going to jump in here. So, we're at the top of the hour. There are contact informations here as well as out in WOVA. My email address, I believe, is in there. So if you have any questions whatsoever, please reach out to us. We'd love to have a conversation with you, and happy to help you out however we can. The one thing I would like to say as well, end it with a thank you again. Thank you for the work you're doing on Montana Housing. I know there's a lot of work and it's hard to do sometimes, but it's also rewarding and you're helping out a lot of people. So thank you very much for everything that you guys do. With that said, Julie, appreciate all you've done today.
You bet.
Thank you.
Thank you, everybody, for joining us this session. Remember, you can always participate in community conversations through the WOVA app to chat some more about it. We will now have a half-hour break and return at 2:30 for our closing plenary session. So thanks for joining, everybody.
Thank
Julie,
you.
can I just ask one question, Julie?
Sure.
I think we provided this PowerPoint to you. Are you able to provide it, or will it be provided to the individuals attending? Because we had such technical difficulties.
Right. It's on the WOVA website for them to download right on the page for this session.
Perfect. Thank you.
You bet. All right.
Thank you.
Thank you.
Thank you. Bye.